but I'll also explain why any loss in a fixed income strategy is typically only a temporary loss, and one that has, in many ways, very little, if any, impact on the investment's main objective, which is to generate reliable income at a fixed rate. Now, before we get into all of that, I'd like to welcome our first guest, Mr. Dennis Gartman. Dennis Gartman is best known as editor and publisher of the Gartman Letter, whose clients include leading banks, brokerage firms, mutual funds, hedge funds, energy trading companies, and grain trading companies. He's lectured on capital market creation to central banks and finance ministries around the world, and has taught classes for the Federal Reserve's School for Bank Examiners. He's highly in demand as a speaker and market analyst and writes a hugely popular blog. Dennis, thanks for being with us today.
Good to be here. You guys scraped the bottom of the barrel and found me.
No, it's our pleasure. You know, it's funny. As you know, we're here today talking about bonds and interest rates primarily.
Yeah.
But 800-pound gorilla in the room. What the heck is going on with the stock market?
You know, I think that we have to understand that after a 9-year bull market, it's probably time for a year or two of a bearish market. Maybe not that long, but we had taken the stock market to almost preposterously, egregiously overbought levels. We really shouldn't be surprised to see a 10 or 15 or even 20%, for lack of a better term, correction from those highs. I think it may well be even slightly larger than that, but let's understand, stocks go up long before economic activity goes up. Stocks began to rebound in 2000, well, the low was what, April of 2009. Mm-hmm. The economy did not turn for the better until almost 2010 and 11. That's to be expected because the monetary authorities are aggressive at those times, force-feeding reserves into the system. And here we are now with strong economic environs, and let's not mistake that we are, in fact, in strong economic environs. But now the monetary authorities are taking reserves out of the system, letting the bonds that they had purchased mature. That's a difference. And at the same time, plant and equipment and demand for labor is strong. Money comes out of the capital markets at this time. We shouldn't be surprised by this fact. So I actually think we're in for a bit more of a downward movement in share prices, and we shouldn't be surprised by that.
It sounds like you're saying that you think the economy's strong, it's just that the stock market has gotten out a little bit over its own skis, and now the economy is going to try to grow into the stock market, but still we're going to have some probably continued volatility and some more drops. So Dennis, stay with us. We're going to be right back to talk to you about the bond market, interest rates, and all that. And our Income Generation members, you stay with us also. We have a lot more in terms of great words of wisdom from Dennis Gartman. Right now, let's welcome back Dennis Gartman. So Dennis, I know you mentioned maybe as much as 20%, and I don't want to spend too much time on this. Again, we're talking about bonds and interest rates today, but you mentioned as much as a 20% correction. I've followed the lead of a lot of technicians who believe that we need to get below that resistance level that existed from 2000 to 2013 rather, that we might actually have to get back down to 1,500 on the S&P before we really recover from the next bear market. You think that's possible?
Oh, I think it's possible. I think it's highly doubtful. I certainly don't think we're going down that far. The best that I'm able to say at this point is I think that we've started a reasonable-sized bear market, and nobody's going to like my answer to this when I would be asked, where do I think it's going to go? The best I can tell you is I think it's going to go lower until it stops. That's the best that one can, that's what I've learned in 40 years of doing this. So to put a price target and a price time on it, I think I'd rather pass. I simply say, right now, the trend is down and share prices are going to continue to move lower.
And that's what 40 years of wisdom brings you. I love it. So let's talk about the interest rates then. What's your take on long-term interest rates? Do you see they're going to level out soon? Do you think they're going to continue to rise? You know, we talked about that. I gave my opinion earlier on the show. Let me get your thoughts.
Well, first of all, I began trading in the bond futures back in the late 1970s. I had my own seat on the Board of Trade. And I can remember when the long bond, and this is hard for people to believe, but I can remember when the long bond had a 14.25% coupon, and you couldn't give them away. I remember when the 8s of 86, a wonderful instrument, went to huge discounts. If I'm not mistaken, at one time the 8s, a 10-year security, traded at 75% of its par value. So for me to think that we could take interest rates 150 basis points higher than where they are, to think that we could take the 10-year instrument to a 4% coupon is really not that hard, a great leap of disinterest. I think we could get there relatively easily over the next 18 months or so. And if we put a 5 handle on the 10-year, that really wouldn't surprise me. And in a great historical perspective, that's really not that high an interest rate.
But how about the demographics today? I mean, how about the fact that we've got so many people out there, there's so much money sitting on the sidelines. I mean, think about what's been happening. Bond prices have been firming up. At the same time, the stock market's been hitting new records every day, in large part because the money's sitting on the sidelines. And as people age, as baby boomers age, they're going to be looking more for fixed income. And that demand, that natural organic demand, has been growing. How do you see that playing into that? Because I see that being an offset, which creates potentially a new norm of lower interest rates. Now not as low as we've seen recently, but not back to 5% per se.
I won't argue with that demographic argument even slightly. It is what will keep interest rates from going back to the levels that we saw in the 1970s and 1980s. Is it going to be difficult to, that tsunami of baby boomer money, and I'm the quintessential baby boomer born in 1950, we do in fact want returns on better than 2%, better than 3%. And we can probably, as I said, we'll probably get the 10-year well above 4%, but that's what will keep it from going to 6 or 7 or 8. The baby boomers needing income and with money on the sidelines and money coming out of the equities market. So rates are going to go higher, but are they going to go visit the levels that I grew accustomed to in the 70s and 80s? No, that's not going to happen.
Yeah, you see, I guess I was looking at it from getting back to a normal value, getting back to maybe 5 or 6% on the 10-year, and then the demographic change really keeping it suppressed below that. But you're saying if it weren't for the demographic change, we could get all the way back to the 1970s, 1980s interest rates. So what would fuel that? I mean, do you see us creating, getting back into the hyperinflationary environment?
No.
Despite the fact that we're struggling to even get 3% GDP, I mean, what would fuel those 1970s rates again in your mind?
Again, I don't think we're going to go back to the levels of the 1970s and 1980s. Can I see the 10-year making it well past 4% and perhaps to 5%? Yes. But again, in the 1970s and 80s, we had 14. That's not going to happen. We're not going to go to those levels again. And it's because of the demographics. It's because of greater productivity. It's because of greater use of computers. All those things are going to tend to keep interest rates lower. Are we going to a hyperinflation? No, not even slightly. We're smarter than that. Even the average person in the public is aware of how money creates inflation. The government is aware of how money creates inflation, and the pressure upon the central banks not to go into a hyperinflationary circumstance will keep rates from going to the levels back in the 1970s and 80s. But rates are going to go higher, just not dramatically so.
Now, in the 30 seconds or so we have left in this segment, tell me, what are your concerns about the new Trump tax plan? Do you have concerns about the amount of debt that we're going to be taking on, what that could potentially do to interest rates? What are your thoughts?
First of all, I am a champion of tax cuts everywhere and all the time.
Great.
When you cut taxes, I think that's a great thing. Do I worry? Quite honestly, I don't worry about the deficit as much as other people do. All I've learned is since the 1980s, the deficit has gotten larger and larger and larger and larger, and yet interest rates have gone down. So I'm not as concerned about deficit problems. Yes, we're going to have a $1 trillion deficit this coming year, but where some people may may wail and gnash their teeth, I won't.
So Dennis, let's talk about this a little bit after the break. I want to bring that back up again, so the concept of spending your way out. Income Generation members, you stay with us also. We have a lot more from Dennis Gartman. But for now, let's welcome back Dennis Gartman. You know, Dennis, you said, it sounded before the break as though you were leaning toward the philosophy that says that, you know, we can borrow more money because we can grow our way out of this. But, you know, I get a little skeptical of that because I think about, you know, if I had a large load of goods that I had to tow with a pickup truck, and let's say I had a quarter-ton pickup truck, and it really couldn't get that large load of goods moving. So I took a 1-ton pickup truck and I hooked it up in front of the smaller truck. And between both of them, I was able to get the momentum going. Once the momentum went, I could detach the 1-ton truck, and I'm sure the quarter-ton truck could keep that supply moving because once we have kinetic energy, it's easier to keep it moving. But eventually that quarter-ton truck is going to run out of fuel. And it's going to have to stop, and it's going to have to start the momentum going again. And that's what concerns me about the concept of spending our way out of the debt, or I'm sorry, growing our way out of the debt, is that eventually we're going to have a recession, but now we've created a bigger load that we need to drag around in the next recession. Your thoughts?
I can't argue with you. I mean, it's exactly what shall happen. All I know is I was told when I was in undergraduate school in the 1960s that higher deficits gave way to higher interest rates. And all I have seen in the course of the past 40 years is that higher deficits have given way to lower interest rates. Now, we argued earlier on that I think that interest rates are going to go quietly higher for the next several years. But the correlation between deficits and interest rates seems to me to have fallen completely apart. We can, in fact, grow our way out of most deficits. What our problem has been in the United States is that when we have cut taxes, which I'm a proponent of cutting taxes, we have simply not done the right thing and cut spending as we should have. There will come a time, you are absolutely right, when the truck will stall and go backward. There shall come a time when that shall happen. But I was told that it was going to happen in the 70s. I was told it was going to happen in the 80s. I was told it would happen in the 90s. I was told it would happen at the turn of the century. And I've been told now it's going to happen in the teens. It hasn't happened yet. It'll happen sometime. I'm not going to lose sleep waiting for it to happen.
Well, as you know, Dennis, what's going to happen is Bitcoin is going to become the world reserve currency, right? We all know that, and everybody knows that. And then that's what's going to happen, right? So I think we just answered our question, right?
Well, let us hope that the Bitcoin does what it should do, is disappear into the ether, to make a very bad cryptocurrency pun. I have been on record saying that I think that Bitcoin disappears and goes eventually well below $1,000 a piece, because it doesn't make sense to me. But that's another story for another time. We'll pick that up at another time.
I agree completely. So, all right, so what about the Federal Reserve? You know, let's say that if you're right, we're okay. If you're right and yields go back up on the 10-year, let's say to 4%, that gives the Federal Reserve more room to raise short-term interest rates and without flattening the yield curve. But let's say that it takes a while, and let's say for the next couple of years that I'm more correct, and maybe we stop in the low 3s on the 10-year. Is the Federal Reserve going to screw it up? Are they going to keep raising short-term rates at the risk of flattening out the yield curve?
Let us hope that the Federal Reserve Bank has learned the lessons of its own mistakes in the past. All recessions in the United States in the post-World War II period have always developed after the yield curve has inverted, where the overnight Fed funds rate has gone to a premium over the 2-year, which has gone to a premium yield over the 5-year, which has gone to a premium yield over a 10. Let us hope that the Fed does not take the yield curve to an inversion. I doubt that they shall. I think no question about it that that the overnight Fed funds rate is going to make its way probably eventually to 2.5%, 3%, maybe even 3.5%. But that shall happen when the 10-year has gone to 3.5%, 4%, 4.5%, maybe 5%. I hope that the yield curve remains positively sloped, because that does benefit the banking system. It's the best thing that can occur to keep the economy moving forward. Let us hope the Fed has learned the lessons of its own creation in the past.
Yeah, that's my big concern, is based upon my interest rate crystal ball. That I'm afraid that could happen. So in some ways, I hope your interest rate crystal ball is better. But tell me, in the last minute or so we have left, our viewers are income generation members. They're all 50 and over. Yes. We both think the stock market's going to go down. Obviously, there's a headwind created for fixed income if interest rates continue to rise, as you believe. So where is somebody who's retired or close to retirement, in your personal opinion, to put their money today?
There's a number of ETFs, closed-end bond funds that exist on the New York Stock Exchange that pay 7%, 8%, 9% yields with dividends that are paid on a monthly basis. I keep putting a great good deal of what I own into those instruments.
Are they interest rate hedged?
No, they're not interest rate hedged, because most of the time their duration is only less than 5 years. And there's a number of them. There's probably 10 or 15 of them. I don't want to mention them on here, because that brings the SEC into consideration. But I tell people, call your broker, call the brokerage firm, look into the Wall Street Journal, go to the web and find them. But when you get paid a dividend on a monthly basis, it really adds up over time. And the duration, go ahead.
Bottom line, as I always say, invest for income. Make the paradigm shift from growth to income. Be more conservative. Dennis, we're out of time. Thank you very much for being on our show today.
I was honored to be asked. Thanks for having me, and look forward to doing it again sometime in the future.
And you don't go anywhere. Stay with us. We'll be right back.